Emily Now to the rescue. On this week's Emily Now episode, I'm going to be talking about what happens when you default on your mortgage payments, what to do if your business is going bankrupt. I'll walk you through an example of a foreclosure that didn't turn out well, but I'll kind of explain why and some of the things that you can watch out for. And I'll be going through an article that the Financial Post had about commercial real estate and how private investors outdid pension funds. So stay tuned. My name is Dylan Gallagher. I'm the founder of mlenow.ca. I've been a finance guy for the past 18 years, helping people and businesses get the money that they need. This is a weekly series that we do on all things finance with a focus on debt. We hope that these episodes are going to help you learn more about what's involved in finance with a specific focus on mortgages and loans, because we believe that you can make better decisions if you're well informed. And with those better decisions, you can save money for the future, make investments in new opportunities, or maybe be in a position to give more to the community around you. So we'd encourage you to follow us. We are on Twitter at mlenow.canada. We are on Facebook. We'd hope you subscribe to us on YouTube, and you can find us on Google Plus as well. Post whatever you want. Ask us questions about mortgages, loans. We every week change up the topics, and we do that to try and keep things interesting and fresh, so there's always lots of things to check out. We'd encourage you to do that. And in every episode, we answer a couple of questions, and the first question for today is, what happens if I default on my mortgage payments? Well, it depends if this is you doing this for your personal home or an investment property, or if you own a business, maybe a commercial property. But basically the process is a bank or lender, you'll miss a payment, you'll be deemed in default. A bank or lender will most likely issue a demand notice, followed by a statement of claim, which means everybody has to go to court, and then the judge decides the outcome. So that's kind of what happens at a high level. There's lots of small things that happen in between, but ultimately what happens when you default on your mortgage payment is that the banks are going to want to sell the property and they're going to want to get their money back. But the banks are going to want to work with you before they go down that road. So if you know that something has changed in your circumstances, so personally either you've lost your job and you can't make the payments anymore, or maybe your business is struggling to survive and make money and it can no longer make the mortgage payments on its property, the best thing to do is to get in touch with the lender and explain to them what's happening. If you're experiencing problems at all, don't wait. Come up with a strategy, or at least come up with a plan to talk to your creditors, the bank or the lender that's holding the mortgage on your property, and determine what it's going to take to get resolution. If you have lots of equity in your property, then refinancing the property might be an option to buy you some more time while your circumstances work themselves out. If it turns out that you don't have enough equity in the property, or maybe your circumstances aren't going to change for quite some time, then it's best to sit in front of the lenders, be honest with them, and just say, look, this is the position I'm in right now, what should I do, and how can we work together to make sure that this isn't more painful than it needs to be for the both of us. The problems that I've seen in the past 18 years when people are making, or rather not making, their mortgage payments is that they don't tell anybody and they keep it to themselves, and as a result the creditor doesn't really know what's going on, and because the creditor doesn't know what's going on, they have to take whatever steps they have available to them under the laws of the province or the country that they're in, and they have to try and recover their capital back. So it's best to get in front of that train when it's leaving the station to figure out, how can I work with these banks and lenders and ultimately solve my problem. I think you'd be surprised to see that while many banks and lenders have a very tough bravado, at the end of the day they need to make sure they get that money back, and working with you is always a better option than trying to work against you, because it takes time, that time costs money, and ultimately that money eats into their profits and into your equity. So if you're in a situation where you think refinancing your commercial building or refinancing your home or your investment property would maybe buy you some more time while you're sorting through a bad situation, Go to mlenow.ca, punch in the amount of money that you think that you need, and then you're going to be able to get an Emily score and see how prepared you are to be approved for refinancing a property. You'll be able to see which banks or lenders can approve you. We have an amazing client services team that can help you through the process as well, and it's free, doesn't cost anything, so jump on and take a look at what you might have available to you. But if you're defaulting on your mortgage payments, the bank's going to want to get their money back, and it's best if you pick the phone up first, talk to them, and try to come up with a solution. The second question we have today is, my business is going bankrupt, what should I do? And the first thing I would say is face the music. Sit down with someone. Your accountant, maybe a consultant, maybe someone that you trust or someone that you think has some financial acumen, and go through the reasons for why your business is going bankrupt. Has the business made some mistakes that can be corrected? Should the business really just close its doors because there's no hope that anything's ever going to change? Can the business maybe change directions and get a different result? For example, if you're in a particular business, is there a complementary business that you can start moving into that would change the course of what's happening? But ultimately get to the root of the bankruptcy, because then once you figured out why you think your business is going bankrupt, then you can have a conversation of, okay, what has to happen now? If this is something that we simply need more time to fix, then that's going to be one set of options and strategies. If it looks like there is no hope, that nothing's going to be fixed, that there's been too much damage done that cannot be repaired, then that's going to require a different set of steps. But ultimately, get down to the reason for why you think your business is going bankrupt, and then start to work through the results. And they may not always be great. The first thing to do would be start with CRA. If you owe Canada Revenue Agency some money, pick up the phone, talk to them, tell them what's going on, and they're going to be instructful in telling you who to talk to and what to do next. After talking to CRA, it's best to pick up the phone and talk to your vendors, the people that you owe money to. There might be legal ramifications if you owe them a lot of money, but at the end of the day, whether you choose to take initiative and talk to the people you owe money to, or whether you decide to get a trustee involved who's going to have to talk to the people that you owe money to, at some point, somebody's going to have that conversation. And once you get over the shock or the fear of realizing the moment that you're in, it then becomes easier to pick the phone up and talk to the people that you owe money to come up with a solution. So if you think that your business is going bankrupt, and if you think that it's not because the business isn't viable, maybe there's just been some circumstances that have forced you into this position, but you think that maybe refinancing or getting a term loan might buy you some more time to fix a problem, then jump on mlenow.ca, punch in the loan amount that you think you need, and then you're going to get a chance to see what the probability is of being approved. But not only that, it'll also show you how someone else sees your business. And so if you send that information in to us, we would be happy to walk you through what we think the options might be for you. And we've got a great team here that can help you do that. But if financing is not something that you think is going to work and really your business is just in a very bad spot, then take some initiative. Figure out why it's in that bad spot. Get on the phone, start sending out some emails, and start trying to figure out, what do you do next? I'm going to give you a real life example here of a situation I was involved in very early in my career that kind of set the tone for me as I watched a particular borrower that we had lent some money to go into foreclosure. We ended up foreclosing on a property, actually a couple of properties that he had owned. He was a builder, and not only did we foreclose, we ended up having to pursue him personally under his personal guarantee, and then got to see him come out on the other side and to see from beginning to end what happens when these situations go bad. So in this case, a builder had just taken on some new lots that he was going to put some new homes on, ended up maybe stretching himself a little bit thin. He didn't have quite enough cash to be able to make up the difference in the amount of money that he had borrowed versus his budget. And so the economy took a bit of a dip, and so one of the homes that he was building didn't sell, and so he had to make the payments on that while trying to build these other homes. Anyway, at the end of the day, I remember after we had issued our demand note and our statement of claim, and we had foreclosed on the properties, and there was still some money left owing. We had sued him under his personal guarantee, and I remember sitting in the trustee, and you know, I think life just hadn't gone very well for him. In fact, over the period of time that his life was imploding, he ended up getting divorced. And I remember sitting in the trustee's office with him as he was signing the paperwork, and he was so nervous and just so devastated. His hand was shaking as he signed the paperwork. And I just remember thinking in that moment, wow, I mean, this guy's not in a good place, and here we are, we're the lender, and we're doing the best job that we can to try and recover the money that we had lent to him. And so I remember just that feeling, and certainly watching him go through it was really, really difficult. But then as time went on, we ended up having to write off some of the loan because we weren't able to get everything that we were owed, and that was part of the risk that we took when we lent him the money. But a few years later, I recall seeing him again and noticing that he wasn't building anymore, but he had remained in the industry and had decided to work under somebody else. So he had taken all of his experience, all of his learnings, good, bad, or otherwise, and had actually made quite a good life for himself after the fact. And so, not to make light of things that are very serious, but sometimes things just don't work out, and that's a fact. You'll borrow money. You will attempt to do something with the best intentions, but sometimes it just doesn't work out that way. And when life goes bad, it's best to get in front of it. And so in this particular case, not only did this builder make it through it, he lost his marriage. I don't know what the result of his marriage was, but I do know that he had some children, and when I saw him a few years later, it looked like he was able to put his life back together, was better for it, and it did cost him, but I think if I were to see him today, he probably would tell me that not only did he learn a lot, but he won't make those mistakes again, and will always make sure that he's not overstretching what he's reasonably able to do. So that might not be the case for everybody, but certainly in this case, something that was very bad at the beginning, and I remember feeling very sad for him, ended up turning out to be something that worked to his advantage. And as a banker lender, we moved on and did other deals, and as a borrower, he was able to change some things in his life and ultimately get his feet beneath him and keep going. So if you feel like you're in a situation of foreclosure, or maybe you're looking down the road and you can see that life's not going to work out, but maybe if you had some more time, or a partner or someone that could help you, or had some capital available, I'd encourage you to jump on mlenow.ca. Maybe borrowing money isn't the right thing to do, but as you go through the website, you're going to end up realizing and seeing some information that you might find helpful in trying to get through your situation. So we've also got a customer service team that can help you sort through that, and so I would encourage you to do that sooner rather than later. There's a great article in the Financial Post by Gary Marr about investors putting cash to work in commercial real estate. Investors need a home for their cash. There's lots of it. $5.1 billion of commercial real estate traded hands in the second quarter versus $6.7 billion in the first quarter of this year. But what's interesting is in the first 3 months of this year, pension funds were responsible for about 31% of the commercial real estate purchases that were made. But in the second quarter, they only counted for 11%, which means that private investors made up the difference. That's a pretty big difference. That's 20%. So I've worked in commercial real estate, primarily mortgages, but certainly am familiar with the marketplace. And commercial real estate's always been a good long-term opportunity. Today, commercial mortgage rates continue to be very, very low, and banks have become more interested in providing capital to investors. What does that mean? Most times a bank will without even thinking, say, look, borrower, we will give you 65% of the purchase price in financing. But today, banks are very quick to offer up to 75% because of where the market is. But something that you should know and understand is the range of cap rates, or what are referred to as capitalization rates, that ultimately determine how much your property is worth. Don't make an offer on a property without knowing what other properties have sold for, not just the price, but actually the rate that was used to determine the price. So what do I mean by that? Well, if a property generates $150,000 a year of net income and the cap rate is 5.5%, that means the property is going to be worth $2.7 million. But if the cap rate used based on other types of properties that are of similar size and location and quality is 6.5%, that means that same property is $2.3 million. So if you're seeking financing and you were buying it for 2.7, the bank thinks it's worth 2.3. In addition to whatever your down payment is, you're going to have to come up with another $400,000 to make up the difference. So why is this important? Well, there is no way to know for sure what the capitalization rate that the bank is going to accept for your property. 5.5%, 6.5%, 6.2%, 5.1%. The capitalization rates really range. In residential real estate, you can look at, 4 or 5 comparable sales. An appraiser will make a plus or minus based on one property having a nicer basement than the other property, or maybe one property being a walkout versus one property not being a walkout. But generally speaking, you can look at comparable sales and just look at the price that was paid and say this is what my property is. But in commercial real estate, it's not the same. The capitalization rate that the bank uses to determine how much the property is worth is a derivative of not only the location of the property, the quality of the building, the expectancy of the building. Does it need a new roof? Does it need some exterior fixing? But it's also the quality of tenants. So if you have a building that has a rent roll on it where most of the leases are coming due, that property is not going to get the same type of capitalization rate that another property would, where it has maybe 5 or 6 strong national companies that have signed 5-year leases. That cap rate will be quite a bit different. So when you're buying commercial real estate, and based on this article, it seems like lots of private investors are, make sure that you know the cap rate before you commit to a transaction. And if you want to see what's involved in getting a mortgage for your commercial property, then jump on mlenow.ca, punch in the mortgage amount that you think you're looking for the property, and it's going to tell you the income and the other requirements that you'll have to meet. As well, it's going to give you the banks and lenders that can approve your deal and kind of what they would be offering you. So jump on, it's free to use. You can get our help if you do want help interacting with the banks, but you can also send your request directly to them using the website. And we're here to help you as well. We've got a great customer service team that can answer your questions and help you put together some of the pieces. So that's it for this week's Emily Now episode. Thanks for joining us, and we'll see you next time.